Hi, I'm Max Keiser. Welcome back to the Keiser Report. Time now to turn to Trace Mayer. Trace, welcome.
Welcome, Max. Glad to be here.
I call you the Howard Hughes of Bitcoin. It's just like you're very corporate looking and business looking, but you're very voracious and you're very ferocious in your approach to Bitcoin. You take the view of a really disciplined hedge fund guy, a Wall Street guy. You got to look at context of the numbers that just came out of Pantera Capital. They're down 72% for the year. And I know that you were laughing at that because a lot of these folks of the past few years, Trace, and correct me if I'm wrong, they got sucked into the siren song of the altcoins and the hard forks and the Bitcoin cashes of the world. And they suffered as a result of it. You have maintained a very strict discipline about Bitcoin, and it's really working well. Can you expand on it a little bit?
Yeah, I mean, scoreboard doesn't lie, right? So, this goes back years. I mean, I've been in this space for a long time, and I've had a different approach to it than the Andreessen Horowitzes, the Panteras, like Barry Silbert, where I've been, I coined the term the hodler of last resort. I came up with, why do you hire Bitcoin? The 7 network effects: speculation, merchants, consumers, miners, developers, financialization, world reserve settlement currency. Those of us that are serious players in Bitcoin, we have a plan for where Bitcoin's going and how we're going to get it there.
Now, I've read your work going back to when you were writing your thesis on banking and gold, and you were well versed in this hard money concept. So when Bitcoin came around in the 25-cent range, you were a ready apostle of Satoshi. You were ready to jump into feet.
Yeah, I mean, that's when I first started publicly talking about it. After Amir Taki brought up having WikiLeaks accept Bitcoin, it's like, well, if we're going to have the scrutiny that comes from more eyeballs on this thing, well, we might as well put in that philosophical foundation. I don't want to have people confused about what they're buying or why they're buying it. It's Bitcoin Cash is the real Bitcoin. I mean, any type of subterfuge or anything like this, I don't want it. Why? Because I want hodlers of last resort. I want people who are willing to hold this thing to zero, right? That have that philosophical foundation, because it's the hodler that really gives something its value. And I think we greatly underestimate the risk of this. Look at how much of investment funds are passive. People just investing in indexes or investing passively. So when the liquidity dries up, poof, we're gonna see massive wealth loss. And what are we seeing with interest rates and the bond market and all of this stuff? Who's going to be the hodler of last resort for Tesla shares or for Apple shares or for whatever the assets are? And why would they be those hodlers of last resort?
Let me talk a little bit about something Warren Buffett said recently, which I think applies here. He said, comparing him with Bill Gates, he said that people overestimate the difficulty of what Bill Gates does, and they underestimate the difficulty of what I do, Warren Buffett, because he is, of course, the hodler, a best-known hodler, his holding period being forever, as he has said.
Which is similar to mine.
Right, and so you've applied this, and so just once again to review the 7 network effects. Number 1 is the hodler. Number 1, if you're holding Bitcoin and you're not being inactive, you're participating in something extremely important in this space, correct? And then the other 6 are, again...
Yeah, I mean, it's all built on the hodler, because that's the speculation demand, and then you've got transactional demand. But let's look at the scoreboard. You got Bill Gates and you got Warren Buffett. From when I started publicly talking about Bitcoin till today, if you take into account the forks, in 7 years, the ROI is higher than Warren Buffett's return in his 50 years.
Right.
By a factor of, I think, 2. So, I mean, Warren Buffett, he's not a very good investor compared to myself, based on the scoreboard and the numbers. And so then you look at Gates. Well, to really understand and get what's going on with Bitcoin, you kind of have to do both. You have to have the discipline of someone like a Buffett, and I've read every single one of his letter to shareholders. I respect him and his investment acumen. But then you've also got to have the creative destruction and the entrepreneurialness of a Bill Gates to really kind of play this thing.
Bakkt is going to introduce some nurse services in this. Talk a little bit about Bakkt, then we'll talk about what you and Caitlin Long were discussing, but talk a little bit about this, as you say, this is part of the 7 network effects. I don't know what number this is.
This would be number 6, financialization weaving into number 1, which would be speculation.
Right, okay.
But then when they're bringing in Starbucks and Microsoft, it looks like they're going after network effects 2 and 3, which are merchants and consumers. So it's and this is how the network effects exponentially reinforce each other. So I mean, this is an incredibly exciting announcement.
Okay, so what exactly did they announce?
Yeah, so who we're dealing with is, these are the owners of the New York Stock Exchange. It's like, I mean, these are the 800-pound gorillas when it comes to markets. And they're going to be introducing next day Bitcoin swaps. So, you know, what they intend to do is take price discovery away from the Bitfinexes and the BitMEXs and move it to backed. Well, they've also partnered with, and they'll also do Bitcoin derivatives. This is later on down the road, and then they have a warehouse custody solution that they're building into this. They've also got to deal with Starbucks and Microsoft. So they're going after 2 global brands. Well, Starbucks is a very easy use case. You know, we got tons of people, why not be able to pay with your app? It cuts down on processing costs, like all this stuff. But why Microsoft? Like, what's the play there? And how does that really go mainstream? And I was thinking about it, and I was like, oh, imagine if Microsoft was able to take some of their revenues from Fortnite and be running it through Bitcoin. I mean, Fortnite makes them like $100 million a month. Something like this. So, you know, if we get transactional demand flowing through this, we get it happening on the derivatives markets, so people can buy and sell calls and puts. They're able to hedge the exchange rate risk. We got large multinationals involved in this. We've got custody solutions for hundreds of millions of dollars of Bitcoin, perhaps billions of dollars.
So with Fortnite, you've already got
this could be huge.
Customer base that are dealing in virtual space.
Yeah, they're doing with virtual items that sell in markets and stuff like that.
Right.
And why not have an instant, like using Lightning Network, you know?
Oh yeah, show your props.
I got my props. It's like
What's going
proof
on
of
here?
Lightning. So if you set up Lightning, you can go buy stickers from Blockstream. And so this is like proof of Lightning, you know? I got Lightning working, but all I got was this sticker. No 2x,
right.
You know, forks, you know, and that's the thing, like if you're gonna be selling derivatives on Bitcoin, you better be fully collateralized or very well backstopped, because if you don't, a hot or last resort with forks or stuff, I mean, we could really disrupt your plans.
We're going
right?
to talk about that. Quickly on the No2X, going back to the SegWit adoption, was there a conspiracy amongst a certain group in the industry to fill up the mempool and slow down transactions? Just as a side note, your view on that?
Yeah, I mean, I don't know that conspiracy would be the right term, but it's definitely within the miners' incentive to fill up the blocks and test the price elasticity of demand and maximize their transaction fees. I mean,
right.
Like, why wouldn't they do that as rational actors? So, I mean, is it a conspiracy, or is it just people acting in a way that the economic incentives, guide people to act?
Okay, you mentioned Lightning. Lightning obviously is second layer. It's the scaling, one of the scaling solutions of Bitcoin, and that's how it would seem to me that now that's really well underway. SegWit was adopted. We're well into second stage. A lot of these altcoins that were created in the period of slow development when things were not coming forward, it looks like they're going to have their lunch eaten.
Oh yeah, and look at poor Pantera or these other people who are highly invested in the altcoins. They've just been obliterated, both in dollars and in Bitcoin. I mean, look at Bitcoin Cash. It's gone from like 0.12 to 0.07 in terms of its ratio to Bitcoin. I mean, this has been a $1 billion plus mistake for Bitmain.
Right.
Bad idea.
Yeah. So yeah, I mean, your track record, just sticking to the true Satoshi vision, you've now outperformed, I would say, everybody in the space, everybody on Wall Street, everybody. You know, you are one of the. You don't publish any numbers.
Why should I?
Sadly, to get a handle on this, but just anecdotally, if we piece together. You've been on this show many times, and we know you've stayed true to your philosophy and your discipline. The rate of return there has got to be fantastic.
Well, and with these new, like with LedgerX and Backed, I mean,
right.
Swap Execution Facility and Derivatives Clearing Organization, the hodlers can now actually start increasing at an exponential rate. What do I mean by that? in down markets or sideways markets, as a hodler, you can actually maintain your Bitcoin position, but then sell covered calls.
Right.
So you can swipe more premium and then turn around and sell cash secured puts with the premium. And so that starts bringing a floor to Bitcoin. So if someone wants to establish a Bitcoin position, they're just going to have to pay very richly for it. And what do I mean by that? Having a strike like 3 weeks out that's up 40%. And so you have to pay the option premium, and then you got to pay that 30% in order to potentially get some small amount of position out of hodlers.
Right. So
hodlers started accumulating even more Bitcoins using their Bitcoin.
Right. So Wall Street's paying the hodlers to scale up, essentially, because of the inefficiency in this option market. And the thing about the option market is that you can use it, as many do, just purely speculate. But as what you're describing is essentially, it's not to use an inelegant term, but there's like a rent-seeking quality about it in terms of you're selling premiums into the market,
right.
And collecting that income. And with LedgerX, correct me if I'm wrong, but I think you have to put up 100% down, right? There's no margin.
Yeah,
right?
they're 100% collateralized,
right.
So they're fully collateralized Bitcoin swaps and options, and then also fully collateralized like cash secured puts.
All right, let me jump quickly to, we got about 2 minutes, because the backed launch and your podcast with Caitlin Long, it's got people talking about, well, doesn't this open up the possibility of Wall Street rehypothecating many over and over and manipulating the prices we've seen in the gold market, et cetera. And you've got an interesting take on this, Trace.
Yeah, I mean, I don't think Backed or LedgerX will be a problem with this, or even Eris exchange, because they'll be fully collateralized. But the CFTC is going to have to keep a real handle on this, because Bitcoin's strictly limited in amount. I mean, it's the hardest money the world's ever seen. No matter where the price goes, it doesn't increase supply. And there's always enough Bitcoin for people. It's just a function of price. So if you're naked short Bitcoin, I mean, that's a good way to bankrupt yourself.
Right. It has attributes that are not found in any other tradable security at this time. Remember Patrick Byrne over there at Overstock went to battle with the New York Stock Exchange and other regulators over the show rule, which demands that you need to show at the end of the day your inventory of positions maybe on stocks that you've shorted, and that because that was not being enforced, people were selling more stock than was even printed or available for Overstock.
Oh yeah, FTDs, you got the Dole Foods case, you got the Procter & Gamble case. I mean, this is a real problem. People don't actually know what they own. And so I think people are taking on a lot more risk than they necessarily think they are.
Right.
And I mean, this is a huge problem. You've got passive investors.
We gotta cut it. I'm going to pick it up from right at that point, but we got to say goodbye now. Stick around for another segment. That's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. If you want to catch us on Twitter, it's Keiser Report. You can download the app, the RT app, and watch our show on your phone, as every taxi driver in Las Vegas does. Until next time, bye, y'all.